Hello. To everyone tuning in right now, you are watching NovaStream, and, as always, we are anchoring the 2 Up and a 4-7 feed.
Hey everyone, glad you're with us.
Yeah, so on our monitors right now, we've got the live crypto markets flashing, the global financial indices are constantly updating, and the breaking news feed is just pulling in headlines from basically every major financial and tech outlet out there.
It is a very, very busy day on the terminals for sure.
Right. But we aren't just here to read headlines at you. We spent the whole morning aggregating Q1 tech earnings reports, official rule change proposals from S&P Dow Jones, and even some live blockchain integration data.
Which is a massive stack of sources to get through today.
It really is. So our mission right now is to kind of synthesize all this raw information and pull out the essential highlights of the day for you.
And, looking at all this data, a very clear, honestly kind of startling theme is emerging.
Yeah, about how the market is entirely redefining what it considers valuable.
Precisely. It's a massive structural shift. Like what historically crashed a market is just being ignored, and what historically drove a stock to the moon is suddenly, well, being met with intense skepticism.
Which I guess brings us directly to the global financial indices, because April 2026 just officially closed out, and it left a massive shock for the market bears.
Oh, an absolute stunner.
Yeah, we are looking at the best month for the S&P 500 and the NASDAQ Composite in 6 years. You
Wow.
had to go all the way back to the wild swings of 2020 to see monthly gains like this.
Which is crazy when you look at the broader context.
Totally. Honestly, looking at the geopolitical sources we've been tracking, this defies all conventional wisdom.
Well, the bears were heavily, heavily betting that all these geopolitical and commodity risks would finally, drag things down.
And rightfully so, right. If you just look at the raw events,
Yeah.
investors just lived through the Iran oil shock.
Right.
We saw dramatic declines in crude supplies. There is still this unresolved tension with natural gas flowing through the Strait of Hormuz.
Huge bottlenecks.
Yeah. And for you, the everyday listener, you are probably looking at gas prices sitting well north of $4 a gallon right now.
Which normally crushes consumer confidence.
Not on. But early consumer data shows that $4 gas hasn't really done much to dent consumer spending at all.
It's remarkably resilient.
It's like, okay, think of it this way. It's as if the market drove past a massive multi-car pileup on the highway and instead of, tapping the brakes, just decided to floor it because consumer spending was holding up.
That is a great way to put it. And the reason the market floored it comes down to the mechanics of corporate earnings. Consumer spending is the engine of the entire U.S. economy.
Right.
So when people are still buying goods, traveling, paying for services, despite those high gas prices, corporate earnings growth tends to remain insulated.
They just keep chugging along.
Exactly. Absolutely. Investors aren't ignoring the geopolitical pileup. They're simply prioritizing the fact that the engine is still humming.
So long as the American consumer keeps opening their wallet, the indices just keep climbing.
Pretty much.
But, if we look under the hood of those indices, this rally is flying largely on the wings of big tech and artificial intelligence.
Oh, heavily concentrated.
Right. And this is where that shifting paradigm of value really comes into play. We are calling it the great AI reshuffle.
Because the way the market actually rewards these AI companies is evolving at just breakneck speed right now.
It used to be so simple.
Right. The initial phase was just blind hype. If you mentioned AI in your press release, your stock surged. But now we are entering a phase of incredibly harsh scrutiny.
And our breaking news feed is showing a perfect side-by-side example of this today. So Alphabet just released their earnings, and the shares closed up 10%.
Massive move.
Huge. They added $421 billion to their market cap in a single day. $421 billion.
Which is almost hard to comprehend.
It's staggering. And that is driven entirely by their cloud growth and AI momentum. But here is where it gets super counterintuitive.
Yeah, the flip side.
While Alphabet is soaring, NVIDIA's stock actually slid 4.6% today.
It seems totally contradictory on the surface, doesn't it?
It seems entirely backward to me. Let's logic this out for a second. All the big cloud companies, including Alphabet, are explicitly saying they are spending more money on AI infrastructure.
Right, building out massive data centers.
Yeah, and NVIDIA makes the chips that power that infrastructure. NVIDIA is the undisputed king of that hill. So if the pie is getting bigger, why on earth is the company baking the pie getting punished today?
Because Wall Street is, they're no longer looking at just the current quarter. They're staring directly at the horizon. And what they see is an incredibly crowded infrastructure layer.
So it's about what's coming next year, not today.
Precisely. Investors are terrified of margin pressures.
Meaning NVIDIA might not be able to charge a massive premium forever.
Spot on. Think about it like building the first commercial jet engine. For a brief period, you are the only game in town, right?
And the airlines will pay literally whatever you ask.
Absolutely. But the second three other massive companies figure out how to build a comparable engine, the airlines start negotiating.
Oh, I see.
Alphabet, Microsoft, Amazon, they are all designing their own custom silicon now. They want cheaper chips. So NVIDIA will still sell millions of chips, but the profit they make on each individual chip, their margin, is under severe threat.
Because they don't have a monopoly on the tech anymore.
Right. Being the dominant first mover just isn't enough to justify a limitless valuation anymore.
Okay, that makes a lot of sense. So the market is kind of shifting its value away from the infrastructure layer and looking for who is actually applying the technology successfully.
The application layer is where the real premium is shifting.
And the sources point us directly to Twilio today, which I think illustrates what practical AI looks like perfectly. Twilio stock just surged 20% on their Q1 2026 results.
The numbers there are just fascinating.
Really strong, right? $1.4 billion in revenue and a very solid earnings per share.
Yeah, and it's their fifth consecutive earnings beat.
But the why is what really matters for you listening. The company cited unprecedented demand for their AI reimagined voice services.
They are doing some really innovative things with telecom.
Yeah, they are rolling out features like branded calling. So if you've ever ignored a call because it was just some random unknown number.
Which we all do, constantly.
Right. Branded calling uses the network to display the actual company logo and the reason for the call right on your screen. And they also deployed AI-driven conversational transcription.
Very practical tool.
Super practical.
Yeah.
Sales for those specific features jumped 100% year over year.
And this is the critical shift. AI that just thinks like, a novel chatbot that writes poetry or whatever is losing its premium.
People are kind of over the novelty.
Exactly. The market is hunting for AI that fundamentally improves core business metrics. Twilio is using AI to get people to actually answer their phones.
Which increases sales and customer engagement for the businesses paying for their service.
100%. The market is throwing money at actual integration over pure theoretical innovation.
But, and this is a big but, even when you have integration and massive numbers, the market still demands perfection if the hype got too far ahead of reality.
Oh, the SanDisk situation.
Yeah, let's look at the SanDisk earnings report that just crossed our desks. The numbers are staggering. Fiscal third quarter revenue was $5.95 billion.
Massive.
That is up 251% from the previous year. They completely shattered the analyst consensus.
And their adjusted earnings were off the charts, too.
Yeah, actually, let's pause on that term for a second. Adjusted earnings came in at $23.41 per share, which absolutely crushed the estimate of $14.62.
A huge beat.
Right. And just to clarify for anyone who doesn't, read balance sheets all day, adjusted earnings basically strip out one-time expenses, like maybe the company sold a building or paid some weird legal fee.
Right, it gives you a clearer picture.
Yeah, it lets you see how the actual day-to-day business of making memory hardware is performing. And by that metric, SanDisk is thriving.
Truly firing on all cylinders.
They are successfully transitioning to these massive multi-year customer engagements. Yet despite all of this, the stock barely moved today.
It was a collective yawn from Wall Street.
Right. It makes no sense at first glance. How does a company grow revenue by 251% and just get ignored?
Well, it's because of the context of the last 12 months. SanDisk stock had already surged 3,300% over the past year.
Wow. 3,300%.
Yeah. So when a stock climbs that high that fast, it becomes priced for absolute perfection.
So the market had already factored those astronomical numbers into the price long before this earnings call even happened.
Spot on. Think of it like a pole vaulter trying to clear a skyscraper.
Okay.
The crowd already expects them to jump over the building, so when they actually do it, it's not a surprise. It was the baseline requirement just to justify buying a ticket to the show.
That's a great analogy.
So that 251% growth isn't a bonus, it's literally the bare minimum required to keep the stock from crashing. Reality simply cannot outpace hype when the hype has been compounding for an entire year.
Man, so we have these massive tech and AI valuations shifting. They're demanding practical results, punishing margin fears. But here's where the sources get incredibly interesting today.
And this is the really structural stuff.
Yeah, because these tech valuations aren't just moving the markets, they're forcing the actual scorekeepers to rewrite the rules of the game.
The index providers are having to adapt to survive.
Right. Let's use the standard index news to kind of set a baseline here. S&P Dow Jones Indices disclosed today that Viva Systems, which is this under-the-radar life sciences software company, is going to replace Coterra Energy in the S&P 500 next week.
Right, simply because Coterra is being acquired.
Right, that is a standard shuffle. Happens all the
A
time.
completely routine changing of the guard.
But late Thursday, we got a real bombshell. S&P Dow Jones Indices announced a formal review process to potentially allow fast-track entry and significantly relax profitability requirements for mega-cap companies gearing up for IPOs.
This is huge.
And the specific names the financial press is floating around this review are SpaceX, Anthropic, and OpenAI.
I mean, this cannot be overstated. It is a seismic shift for the financial landscape. Historically, the S&P 500 has been the absolute gold standard of index funds because it required GAAP profitability.
Let's break that down real quick. GAAP stands for Generally Accepted Accounting Principles. It's basically the financial equivalent of a polygraph test,
And
right?
that's a really good way to view it.
Yeah.
GAAP rules ensure that a company is standardizing its financial reporting and, crucially for the S&P 500, proving it generates actual sustained profit over several quarters.
So you couldn't just pitch a visionary story and get into the S&P 500.
No, absolutely not. You had to prove your core business model generated more cash than it burned. It acted as a strict filter for stability.
The analogy that came to mind when I read this source was, think of an exclusive old money country club. They've had a strict dress code for 100 years, right? Jackets required.
Right.
But suddenly they look out the window and realize all the most powerful, wealthy, influential people in town are hanging out in the parking lot wearing hoodies.
That is exactly what's happening.
So the club management is hastily tearing down the dress code just to get them inside the building before the club becomes completely irrelevant.
The risk of irrelevance is the main driver here.
Yeah.
We now have these high-risk, high-reward unicorns like OpenAI and SpaceX that command private valuations larger than most of the legacy companies currently sitting in the S&P 500.
Which is wild to think about.
It is, but because they burn massive amounts of cash to scale rapidly, they might fail traditional GAAP profitability metrics.
But wait, if they fast-track unprofitable companies into the 500, doesn't that fundamentally change what an index fund actually is? I mean, millions of people listening have an S&P 500 index fund sitting in their 401k, assuming it's a relatively stable, slow, and steady retirement vehicle.
It changes it completely.
Wow.
Yeah, if this rule goes through, the baseline definition of a safe index fund is altered. It's akin to opening up your secure vault of government bonds and, mixing in a bunch of lottery tickets.
Right.
Yes, the tickets have a very high probability of paying out massively, but they introduce a risk profile that the S&P 500 was originally designed to exclude.
So the S&P is literally bending its sacred rules to accommodate the new reality of these hyper-growth tech giants.
For sure.
But while the entire market is bending over backward for unprofitable space and AI unicorns, we also need to look at what is happening to the ultimate traditional value play. I'm talking about Berkshire Hathaway.
The ultimate old guard is really struggling to maintain its footing in this new paradigm.
Yeah. In this post-Buffett world, under the new CEO, Greg Abel, Berkshire's stock is suffering. According to the charts we pulled today, it has been lagging the S&P 500 by over 30 points since the leadership transition was announced.
That's a significant lag.
It is. Investor anxiety is super palpable, and I have to ask the obvious question. With the Warren Buffett mystique officially gone, shouldn't investors be genuinely worried that the magic touch has left the building?
It's a very natural emotional reaction, but if we isolate the underlying data from the sentiment, this is actually a fantastic development for long-term investors.
Really? How so?
Well, the fundamental intrinsic value of Berkshire's diverse cash-generative businesses, the insurance companies, the railroads, the energy grids, that remains entirely intact. What has vanished is simply the Buffett premium.
Meaning the extra tax investors were willing to pay simply because the Oracle of Omaha's name was on the door.
Precisely. And because that premium has evaporated, Berkshire's valuation has dropped significantly. We are looking at a price-to-book ratio that fell from 1.8x down to around 1.4x.
Okay, let's simplify that for a second. Price-to-book ratio, basically the book is what the company would be worth if you sold off every single desk, factory, and piece of inventory today.
Yes, it's raw liquidation value.
Got it.
At 1.8x, investors were paying $1.80 for every $1 of actual assets Berkshire owned.
So the extra 80 cents was the Buffett premium and future growth expectations.
Absolutely. Now it's down to 1.4x. And historically, whenever Berkshire's stock hits that 1.4x level, it has been the trigger point for the company to aggressively buy back its own stock.
Because management basically views the shares as practically on clearance.
Spot on.
And they certainly have the money to buy those shares back. I mean, the filings show Berkshire is hoarding massive cash reserves right now. They explicitly decided to ignore speculative AI stocks and just hold cash.
Which is definitely driving some of the current market panic.
Yeah.
But we have seen this movie before. This situation mirrors 1999 almost perfectly.
Oh, the dot-com bubble.
Right. During the height of that bubble, Berkshire was heavily criticized by financial media for sitting out. They hoarded cash while everyone else chased internet stocks that had zero earnings.
Sounds familiar.
Very. Berkshire stock dropped, analysts claimed the magic was gone and that Warren Buffett had lost his touch.
And then the bubble burst.
The bubble burst, and following that 1999 drop, Berkshire deployed its cash and vastly outperformed the broader market for the next 5 years. So Greg Abel, who already has a strong, proven track record running their operating companies, now sits on a massive war chest of cash. He can make huge acquisitions while the rest of the market is arguably overvalued and totally obsessed with AI.
So it's a play based on intense patience and, the physical, tangible world.
Yes.
But contrast that patience with a wild pivot from another legacy brand we were tracking today. Hertz shares boomed 20% on Thursday.
Hertz is such a fascinating case study in reinvention right now.
It really is. I mean, everyone remembers Hertz from the meme stock craze a few years back when retail traders were trying to squeeze short sellers.
Oh yeah, a wild time.
But today's 20% soar is based on a very tangible partnership. Hertz announced that its affiliate, Oro Mobility, is partnering with Uber Technologies.
A huge deal.
Yeah, they're going to manage the day-to-day operations of Uber's robo-taxi vehicles in the San Francisco Bay Area. They're working alongside partners like Lucid Group and Nuro, who have been building these custom robo-taxis.
The irony there is wonderful.
It is.
Hertz, a company traditionally associated with, long lines at airport rental counters, is finding legitimate forward-looking market value by embracing the friction of the real world.
The friction of the real world, I really like that. Because Uber and Lucid can write all the brilliant AI code they want and build incredible autonomous vehicles.
Right.
But an algorithm doesn't know how to clean spilled coffee out of the backseat.
Yep.
An algorithm can't physically plug a charger into a port or swap out a flat tire. Someone still needs to manage the physical logistics of a massive fleet day to day.
Which is incredibly labor-intensive.
Exactly. I mean, absolutely. Hertz is connecting its massive existing real-world infrastructure to the AI dreams we were discussing earlier.
It's physical infrastructure meeting digital ambition. It really proves that the AI revolution still relies heavily on the messy, tangible world.
Speaking of digital ambition, let's pivot to the NovaStream live crypto markets, because the integration of digital finance is colliding with a truly bizarre contradiction today.
Oh man, it has been a wildly unpredictable 24 hours regarding the platform X.
Yeah, so X, formerly Twitter, just launched a massive financial update. They rolled out what they call smart cash tags on their web version, starting initially for users in the US and Canada.
And this is a big step for them.
It is. If you type in the cash tag for major cryptocurrencies, Bitcoin, Ethereum, XRP, Dogecoin, Solana, or even crypto-adjacent stocks like Coinbase and MicroStrategy, and click it, the platform now brings up real-time interactive financial charts right inside your timeline.
This is a major structural change. It aligns with their stated goal to transition from a microblogging site into an everything app.
Right.
They're effectively turning social media timelines into a retail trading terminal.
And they're actually taking the security side seriously, too. They introduce account locks and something called contract address matching, specifically to prevent fraudulent token promotion.
Contact address matching is really vital here.
Can you explain how that works?
Sure. For those unfamiliar, think of a contract address like the unique routing number on a bank check. It guarantees the money is interacting with the authentic blockchain network. It prevents a scenario where a user clicks on a Bitcoin cash tag, but is actually routed to a copycat scam token that someone coded in their basement 5 minutes ago.
Ah, I see.
Yeah, X is basically verifying the digital routing numbers behind the scenes.
So they're building robust, secure crypto architecture. But here is the massive contradiction that crossed our news feed.
The timing is incredible.
It really is. While X is deploying this elaborate infrastructure, its owner, Elon Musk, just testified in an OpenAI-related court case that he believes most crypto are scams.
A very sharp departure from his historically vocal support for the industry.
It's completely jarring. I read that testimony and thought, it's like building a state-of-the-art high-security casino on your property, outfitting it with real-time tickers and VIP lounges, and taking a cut of the action,
Right.
while simultaneously testifying in federal court under oath that you think the games inside your own casino are totally rigged. How are we supposed to reconcile the platform's actions with the owner's testimony?
You reconcile it by recognizing that infrastructure always outlives personal sentiment.
Okay, what do you mean by that?
Well, Musk's personal skepticism, his belief that the majority of digital assets lack fundamental value, that doesn't change the business imperative of his platform.
X still needs to make money.
Precisely. X wants user engagement, they want financial data, and they want to monetize the activity of millions of retail traders.
The platform's revenue goals just supersede his personal testimony in a courtroom.
100%. Furthermore, if you monitor the markets, you have to look at institutional actions over individual words. Tesla continues to hold Bitcoin on its balance sheet.
Good point.
So the deeper takeaway for anyone monitoring these crypto markets is that the infrastructure is maturing and becoming undeniably embedded in mainstream tech.
Yeah.
When a platform as large as X starts building tools like contract address matching to distinguish legitimate assets from scams, the rails of digital finance are being permanently laid down.
That makes a lot of sense.
And that happens regardless of what any single individual says on the stand.
So the infrastructure keeps building, even if this architect is openly skeptical. Okay, let's pull all of these disparate sources together and wrap up our highlights of the day.
We covered a lot of ground.
We did. We've seen a very clear through line today about how value is shifting. We have major indices flying blind past oil fears, purely propped up by the sheer momentum of consumer spending.
Right. And we observed the AI market maturing, really demanding practical revenue-generating results from companies like Twilio.
While punishing hardware giants like NVIDIA over future margin compression.
Spot on.
We watched the S&P 500 prepare to bend its century-old rules on profitability just to capture the new wave of hyper-growth tech giants.
It's a historic shift.
Huge. And we found the hidden value in Berkshire's dip as the Buffett premium fades and they hoard cash for the next crash.
Patience over hype.
Exactly, for sure. And we watched Hertz reinvent its physical footprint for the robotaxi era, while X paradoxically builds out massive crypto infrastructure.
Understanding how the market redefines these rules is really the only way to navigate it.
And that brings up a crucial question for anyone managing their own investments based on today's highlights.
Yeah, a really important takeaway. We've seen today that the Buffett premium can vanish entirely, leading to a massive drop in valuation, despite the company's strong fundamentals remaining totally intact.
Right.
At the same time, we see the market happily pricing years of absolute perfection into companies like SanDisk, leaving no room for error whatsoever.
It's a tightrope.
So as you look at your own portfolio tonight, think about this. What hidden premium are you currently paying for in today's tech giants? And what happens to your retirement account when the market suddenly decides it's no longer willing to pay for that mystique?
A heavy but essential question to leave you with for May 2026. Thank you for tuning into this segment. Remember, the global markets never sleep, and neither do we.
Keep an eye on those charts.
Absolutely. Keep it locked right here on NovaStream for live crypto updates, continuous index tracking, and breaking news all day and all night. Goodbye.